Pay taxes now or later? That's the big question behind a Roth conversion. It's an important strategy that can have a big impact on your retirement. Today we'll cover what is a Roth conversion and how it works, why some choose to convert while others hold off, and how to start evaluating if a Roth conversion is right for your retirement plan. Hi, I'm Molly Nelson here with Clint Hunt-Rods and Loren Merkle, and it's time to talk about Roth Conversion 101. So we're back in the classroom. We're going to teach everybody what a Roth conversion is all about. So Loren, start with just a basic definition of a Roth conversion.
Yeah, what a Roth conversion is you have pre-tax savings. Most of you, it's going to be in your pre-tax 401k or your pre-tax IRA. So this is money you've never paid taxes on before. You will at some point pay taxes on it. So what a Roth conversion is you're intentionally deciding to pay taxes now on at least a piece of that money. So you take some money from the pre-tax IRA, you convert it over to the Roth, and in the year that you convert it, you do pay federal taxes at your ordinary income bracket. And some people, based on a number of scenarios, could also pay some state taxes as well.
Okay, let's get to then spending the money. So that's how the conversion works. But then when you put the money into the IRA or the Roth IRA, what happens next?
Yeah, once it's in the Roth IRA, then it's able to grow tax-free, which can be a lot of the value that you have. Is once those dollars are in there, it's work to get them there, but then they can grow tax-free forever. You can take those distributions out down the road, provided that you meet some of those requirements. 59.5 is a triggering event that you want to make sure you're aware of, as well as the 5-year rule that applies to Roth IRAs. But once you've met some of those stipulations, you can take those dollars out tax-free. If you don't spend them in your lifetime, they will pass on tax-free.
Yeah, and the tax-free is the part that's really important, and we will talk about that a lot, but I want to go back to some of the nuance here and make sure everybody understands. You could get to the money before 59.5, right, Loren, but there is a penalty?
Yeah, there can be a penalty if you don't have a qualified distribution. That penalty is 10% of whatever amount you took out that you weren't supposed to take out based on those rules.
Okay, and let's go to the 5-year rule too. I just want to dig into that just a little bit more. Exactly how does that work with a Roth IRA?
Yeah, what you want to think about is making sure that you've had that 5-year clock started on when you've had your first Roth IRA. A Roth 401k does not count towards that. So you want to get that Roth IRA started as soon as you can, get that 5-year clock rolling. That allows you to then be able to not just have contributions or conversions you can get back, but then now we're also able to get to those earnings tax-free.
Okay, tax-free. We're hanging on to that one. I want to go back, though, to one other thing that's an important distinction between a traditional IRA and a Roth IRA, and that is required minimum distributions.
Yes, a required minimum distribution means, for most people, once you obtain a certain age, and for some of you it's going to be age 73, some of you it's going to be age 75, you are mandated to start taking out a piece of your pre-tax IRA, whether you want to or not. You're mandated to take it out, and then you will pay taxes on that required distribution. That's with the pre-tax IRA. With the Roth IRA, one of the benefits is you do have more control on when you take the money out because you do not have a required minimum distribution at age 73 or 75 or even 95. You can allow that money to continue to grow tax-free for as long as you want to. One of the benefits of having that money underneath the Roth.
Okay, so we want to help people understand what the Roth conversion is. I think you guys did a great job with that. Now, why to consider it? Let's talk about some of the positives of a Roth conversion. Tax diversification, it does help create that, Clint.
Yeah, it's something you always want to be thinking about is, we're used to thinking of diversification across your portfolio. As we think more about retirement planning and your retirement plan, we want to create tax diversification. So we're likely going to have some of those pre-tax dollars that we have saved. Those will be taxed at earned income rates as we take those dollars out. It can also be beneficial to have another bucket to draw from. Roth dollars you can get out without creating a taxable event. You can get to those dollars tax-free. And then in some cases it makes sense to have a third bucket, more of a non-qualified or brokerage type of account, where there you can get your cost basis back without tax. You would just realize capital gains on the growth within that account as you sell a position or you take those distributions out.
And one of the real benefits of creating that tax diversification is then you have more control over your retirement tax bill as you go through those retirement years. Because if you have those 3 different tax buckets, you can choose to take some money from the pre-tax accounts, take some money from the tax-free accounts, take some money from the tax-preferred, that non-qualified account that you were referencing there, Clint. And then what it does is it allows you to be very intentional over the taxable income you receive in any given year, which means you can keep your tax bill down for that year. And the way you take the income from those different accounts can vary year over year based on any types of other income or tax strategies you have as well. The key with creating that tax diversification is it gives you more options, gives you more control, and has the ability then to decrease your retirement tax bill.
And that gives us a lot more options. And when we want to stay under a certain tax threshold, a certain bracket that we don't want to get to the next one, we're thinking about the One Big Beautiful Bill Act senior bonus, and we want to stay under a threshold as a result of that. We also can think about that healthcare and that IRMA premium increase. If we go above a certain amount, if we have Roth dollars we can draw from, or non-qualified dollars, we might be able to stay under some of those different thresholds. That gives families that we're working with more power and control.
And one more thing I want to mention under why to consider a Roth conversion is it does provide a tax-free legacy potentially when you pass that money on to your heirs.
It's certainly more tax-friendly to your beneficiaries than a pre-tax IRA. You still have the 10-year requirements, or the beneficiaries still have the 10-year requirements where they have to have that money out of the Roth or the pre-tax within 10 years. But when they take that money out of the Roth, it comes to them tax-free, as opposed to they inherit a pre-tax IRA. They have to take it out. They're taxed at their ordinary income levels. And for many people at that phase of their life, based on their earnings with their working career, they're probably at the highest tax rate they've ever been. Add this inheritance on top of it, so it can be problematic at best inheriting a pre-tax IRA versus the benefits of inheriting a Roth IRA.
Yeah, the Secure Act really changed the game as far as being able to, previously you could stretch an IRA out. Now with that 10-year distribution window, stacking it on top of whatever household income is already present, that can be a really big change as far as just thinking about how do we be efficient across our legacy.
Let's talk about why it's not for everyone. One thing that you have to consider is you will owe taxes immediately. You're choosing to pay taxes in the year you convert.
Yeah, you're choosing to pay taxes. Now, that by itself doesn't necessarily mean it's a bad thing, but it's definitely a reason to consider it. You will pay taxes in the year you convert. Does it make sense for you in that particular year to add more taxable income to your income situation? That's an evaluation that you have to make, and you have to be really diligent in making that calculation before you answer the question, is a Roth conversion right for me this year? And then you also have to look forward and say, if you don't convert this year, because you know you're going to pay taxes on this money at some point, if you don't do it this year, what if you do it next year? What if you do it the following year? What if you wait until you retire, potentially your tax brackets go down? Does it make sense to do it at that point? All of that is a part of the consideration.
I recently had a family that had come in, they've been watching our show for years, and they came in and they just said, hey, we're ready to do conversions. We've been contributing to our Roth 401k. And as we built out their plan and started to walk through this more specifically, it actually didn't make sense for them to contribute to the Roth 401k or to do a Roth conversion because they were in a much higher tax bracket during their working years than they would once they hit their retirement years. And they did not have an issue down the road with required minimum distributions based on some of the planning that we did. And so it's not for everybody. It's something that you want to think about within your larger plan, what makes sense each and every year.
Yeah, that's a really important point, because oftentimes people will come to us and say, hey, my brother told me I need to do Roth conversions, or I've been watching your guys' show and you guys talk about Roth conversions. I need to do some Roth conversions. Right, they get this information from a lot of different sources, but does it apply to you in the same way? Does it make sense for you? And that's why that plan is so important, to make sure that these decisions you're considering, these decisions you have to make, and the strategies you're considering make sense. The Roth conversion is permanent. So once you do it, there's not a fix. There's not a do-over. You have to make sure you get it right.
We're trying to help you decide Roth conversion, yes or no. And one way you help people decide, Loren, sometimes is to just quantify what it could look like.
That certainly does help. When you intentionally choose to pay taxes on your retirement savings, this savings that you've been spending a lifetime creating, when you intentionally choose to pay taxes on it before you have to, you want to make sure you're making the right decision, and putting some tangibleness around this decision really does help make that decision. Do you convert? Do you not convert?
Clint, I think you have an example that'll help us decide.
Yeah, so that's hard to sometimes quantify how much value is there from doing a Roth conversion? And every plan's different. So we've kind of broken these up into two scenarios. What if we do a conversion? What if we don't? As we walk through this, we're really just kind of identifying, does a Roth conversion make sense? What's the quantifiable value that we can find from that? So scenario one, this is just, we're thinking about $100,000 that has been saved in a pre-tax IRA. And with those dollars, we're going to think about not realizing any sort of tax this year, allowing these assets to continue to grow tax deferred. So this sometimes feels good. I don't have a bigger tax bill this year, and I'm going to continue to use that IRA for what it was designed for. Now, as we look over time, that $100,000 over a 25-year time horizon, if we receive a 6% growth rate, grows to $429,000. But when we start to think about taking distributions out, well, we can't get to that full $429,000 because we've grown tax deferred. We have a tax bill that's waiting for us on those dollars. And if we think about this particular example, this family has the 24% bracket available to them for required minimum distributions or any sort of income distributions that they're going to take out. So when they take that $429,000 out and that 24% tax bracket, they have a tax bill of around $103,000 that they should expect. That leads to a net amount that they can actually get out to take, spend, get to their bank account to do some of those things they're looking forward to in retirement of $326,000. So as we look at that, quantifiably, this is keeping those assets in the tax deferred bucket, growing them in the IRA for a longer period of time. Let's just flip and now start to think about what if we took that same $100,000 and instead of continuing to grow it tax deferred, we implemented a Roth conversion. So on this conversion scenario, this family is in the 22% bracket at this portion of their retirement journey, and they would be facing a $22,000 tax bill to complete that Roth conversion. Sometimes that doesn't feel good. They need to know that this is going to be in their best interest over the long run, which is why we want to look at the context of their overall plan. But when we find this family has that $22,000 tax bill, they believe in the long-term benefits of that Roth conversion, so they're willing to accept that, pay the $22,000 with bank assets that they have. That allows them to get that full $100,000 converted and into that Roth IRA where it can grow tax-free. Now, when we think about that over that same 25-year time horizon with that same rate of return of 6%, it grows to $429,000 just like the pre-tax IRA did. But the big difference comes in if they want to get those dollars out, they can get all of that out without tax. And so that becomes the really powerful aspect of this. Now we start to think about this over time. They did have that tax bill earlier on when they did that conversion. So just for comparison's sake, we'll add that in, or we'll subtract that from the $429,000, showing a net amount of right around $407,000 they can get out tax-free. We compare that versus the pre-tax IRA, and we find that $326,000 growing it tax deferred versus that conversion, they have $407,000 that they can use for their lifestyle as far as spending goes, or they can pass it on. And they have that full $407,000, which is a difference of about $81,000. Now we start to think about that and the power of that conversion, helping them reduce their tax bill by $81,000. That becomes really, really impactful. And this is just one conversion of $100,000. The family might actually have the ability to do even more conversions over time.
Clint, one of the things I'm thinking as you go through that example, you made the comment it doesn't feel good to pay taxes on that Roth conversion, but I can tell you it's never going to feel good, but it's going to feel a lot better when you know the outcome is you're going to be $80,000+ ahead just by that one simple strategy. Most of the time when people are engaged in Roth conversion strategies, it's a multi-year conversion strategy. What Clint just walked you through is a one-time, 1 year, $100,000 Roth conversion, and it's still made a huge impact over the course of that time frame that you just discussed, that 25 years. Another key note there is the way that they paid taxes. because you do have options of how you pay the tax bill when you do that conversion. In your example, Clint, you said they paid it out of the bank, which means that they had some money at the bank earning whatever the bank is paying, and they chose to pay the tax bill out of cash. Whereas you do have the option to do that if that fits you, but you can also pay that tax bill from the conversion itself. So if it's a $22,000 tax bill, you convert over $100,000. That actually means $78,000 is going to go to your Roth, and the $22,000 is going to come from that conversion. That's a strategy too, and actually that's probably a more common strategy, but you need to consider all of your tax paying options as you engage in these types of strategies.
Yeah, and in this particular example, we were looking at 22% now versus 24% later. That gets to the importance of not just thinking about what's my tax bill this year, but what's it next year, what's it going to be 10 years, 20 years down the road, and we start to take that longer term view. It helps us make these decisions with confidence, more in the here and now, right here. What opportunity do I have this year, knowing what brackets available to me, and then thinking about what brackets might be available somewhere down the road.
Yeah, in your example, not only did this individual end up with more money underneath the Roth conversion strategy than if they didn't convert, but that money is all tax-free whether they use it or they pass away, and that goes on to the beneficiaries, where now the beneficiaries can use that money tax-free as well. So it can be a multi-generational benefit type of legacy decision that a lot of people need to consider, the now and the later.
Now we want to go over 3 important questions to ask before you convert. So question number 1 is, how will you pay for the taxes? In your example that we just went over, they were able to pay with some bank money, but definitely something people want to consider before conversion.
Yeah, part of it is, do you have the money to pay the tax bill out of pocket? Do you want to withhold from that? And part of that becomes, what age are you? Before 59 and a half, you have to pay that Roth conversion bill out of pocket. After 59 and a half, you're able to withhold from that conversion. It's going to end up being less that gets converted, but that can make sense. And that's what a lot of families will consider as a way to complete that conversion without having to bring a lot of money off of, maybe the assets they have in the bank, or tapping into another part of their portfolio to pay that tax bill. That might not always make sense.
Question number 2 that you want to ask before a Roth conversion: are your tax rates likely to be higher or lower later?
And there's multiple things that go into that consideration. One is, what is your income now versus what your income down the road is going to be. Let's just go through a quick example. We got Roger and Sherry. They retired at age 63. They had really good earnings while they were working. And when they retired, they didn't want to take their Social Security. In their plan, it didn't make sense. So they were living on cash, and cash is not taxable to them. So they had the ability to do Roth conversions because their tax rates dropped down after they retired, and they were going to stay down for a few years. So we could take advantage of some conversions at really low tax rates they haven't seen in a very long time. For them, in that example, because they have some cash to live on, that makes a lot of sense. So that is part of the consideration. The other part of the consideration is legislation. Tax rates can change based on legislation. Right now, the lowest tax rate that we have is 10%. We have to go back decades before we see another tax rate as low as 10%. Right now, the highest tax rate we have available to us is 37%. And the highest tax rate that we've ever seen, decades ago in the 40s, was 94%. So people feel like tax rates are kind of high right now, and that doesn't feel good, but they have been much higher. And down the road, with record high levels of debt in our deficit, it's possible that tax rates could go up in the future. So that is also a part of the consideration. Where are current legal tax rates now versus where we think they can go down the road? All of that plays into it.
And one thing that I always like is, as we build plans out for families, we want to make this visually appealing so you can understand it better. And something that we often see is that maybe as you're in your working years, your tax bill's up here, but then in retirement, it drops down. And for a while, it might be lower, but then RMDs can hit and move it back up. So it's almost like the U, right? We're not thinking about the University of Miami, but that tax bill where we're higher, then we've got it lower for a period of time. But once we reach 70 73 or 75 and RMDs come into play, that could push us back up. And so if you've got that big U, that becomes that window of opportunity in your retirement plan. You want to make sure you're taking advantage of any sort of conversion opportunities when you have that lower bracket available to you, which is often from retirement out till RMD age.
Which is why it's so important not just to look at this year, what does it look like this year? We have to look at what your situation and external situations could look like 5, 10, 15 years down the road as well. All of that is going to go into your this year decision.
Question number 3 to ask before a Roth conversion: when will you need the money?
Yeah, so this is something where we showed the value over a 25-year period. If you're thinking of a time horizon of 2 years, well, then it might not make as much sense. You're not going to get as much of the tax-free growth and benefit, and you might be in the same bracket now as you would be in a couple of years. A Roth conversion might not make sense if it's just a couple of years, but we start to think about planning for retirement, we're thinking more in decades. And as we think more in decades, we can see how the power of that compounding growth in the Roth bucket can really impact your plan in a positive way.
There are a lot of specific scenarios that can make a Roth conversion right in one year and not right in another. And it's definitely applied differently to each person. And a Retire Ready call is a good chance to kind of apply some of what we're talking about today to specific situations.
Because in the Retire Ready call, we can really get into the customization. How old are you? How long before you want to retire? Are you already retired? What is your income? What is your projected income down the road? What are the tax rates right now? We can go through that with specifics based on the income. What do we think tax rates could do down the road? This is where we can really get customized into what your situation is. And then we can talk through some of the what if scenarios and really get you on a good track to determining, does a Roth conversion make sense or does it not?
And sometimes families are wanting to schedule that Retire Ready call when there's market volatility. And that's something to think about as well, is if a Roth conversion makes sense to you in a given year and there's a market dip and a downturn, then a Roth conversion could really make sense to take advantage of that opportunity within your plan. Then you can do that conversion, pay less tax on those shares as you convert them over, and then you can receive that benefit or that growth and recovery on that tax-free side. So if you're thinking about a Roth conversion, if it makes sense for you and there's market volatility, that can even enhance the opportunity that's present in your plan.
Yeah, that's a great point, because sometimes people say, you know what, the market's really crazy right now. It's kind of scary. I just want to hold tight. They kind of just freeze. Where in reality, this market volatility can create some additional opportunity, some additional benefit to you. And this strategy is all about how do you use market volatility as an opportunity? How do you use the market volatility as a benefit to you instead of just freezing, feeling like you have no control over what's going on? You can actually take control over the controllables in your plan.
And that's part of just having that plan, is that we now know what opportunities we're looking for down the road. And what we don't want to be doing is scrambling to build your plan as you've got these big opportunities present, or maybe a retirement date is shifting. I recently had a Retire Ready call, and the individual on the other line, she had just received an early retirement package at work. She's never built out her plan, and she had so many questions. She really just said, I don't even know where to begin. So we just started to walk through, what it's like to have a retirement plan, the different things that she should be thinking about. And that's something that it would be a lot better if we had that plan already built out. Then we know when that retirement package hits, or that work opportunity changes, or all those different life factors that can change your retirement date. We'd rather have the plan built first, then we know the opportunities, rather than trying to scramble when we have those big decisions.
It sounds like after that call, though, at least she had a clear first step. She had a lot of cards out on the table. She didn't know which one to pick up first.
She was just so thankful for the opportunity to talk through it, because she felt like she was on an island. No one was really there to help her. The advisor she'd worked with wasn't really a retirement planner, and she was just looking for more guidance and somebody to talk through it with. We had a great conversation.
A clear first step. That's what a Retire Ready call can provide. Go to retirereadycall.com right now and you can schedule a call. There's a calendar there. You can choose a time and a date for you, and then you can have a conversation with a retirement planner. It can be about Roth conversions. It could be about an early retirement package, maybe a pension, maybe any concerns that are on your mind. It's a pretty low-key, complimentary call about your retirement. This is Retiring Today, and we thank you for watching.
Thank you for watching. If you enjoyed this, click here for another video. Be sure to subscribe to get more engaging retirement planning content.